fees, very low taxes.
Money matters with the experts on the global scale.
What a way to run your life.
Personal finance on Smooth 98.1.
Why aren't you? Okay, bring us in, please.
All right, 18 minutes past 5 on this wonderful Wednesday evening on the Smooth Drive on Smooth 98.1 FM. And it's time for us to jump right into personal finance, where we talk about your money, finances, and of course, how to, should I say, grow it in 2023. And it's going to be a great conversation, as always, on the program. Today, we have with us to discuss basic metrics to consider when selecting stocks in 2023. We have with us Ayodeji Ebo. He's the MD and CEO of Optimus by Afri Invest. I hope I got your surname correctly. Please forgive me if I murdered the name by any chance.
Good evening, Ayodeji. Thanks for joining.
Yeah, good evening. Good evening, Lagos. It's nice to be here again. Happy New Year.
Happy New Year to you too.
All right, do join the conversation. We're already streaming live up on youtube.com/smooth981FM Lagos. You can join the conversation by using the live chat option on the live stream, or you can send WhatsApp messages to 0809-440-981. Or if you're a Twitter fan, then go ahead and use the hashtag personalfinance981 is the right hashtag to get in on the conversation. So the first thing that we're going to be talking about, if we're talking about basic stock picking metrics, is why even invest in stocks to begin with? They go down, don't they?
Okay, thanks. Investment is all about return, and there's also that law of the principle in investment: the higher the risk, the higher the return. Like you said, they go down, but they can also go up, and they can also deliver returns that are higher. The first thing to note as an investor, potential investor in stocks, is that you need to understand your risk appetite. If you are the type that if you buy a stock at 10 naira and it drops to 9 naira 50 kobo, and you will not be able to sleep, or you'll be calling your investment professionals, then stock is not meant for you. Because what we have seen, if you look at the trend in the last even 50 years, is always a trend. It's like economic is in cycles. So stock market is also in cycles. So it's meant for those that understand and also have that habit to be able to wait it out, and also be able to withstand whatever volatility that you see. So people invest in stocks for return. You either invest for dividend or you invest for capital appreciation. So when we say capital appreciation, it means increase in the share price. So you buy at 10 naira, and when it gets to 15 naira, you take profit. That means you sell and you make your money.
All right. You mentioned earlier that you need to know your risk appetite, and you give the example of somebody who buys a stock at 10 naira and then it drops to 9 naira 50 kobo, and they can't sleep. They start disturbing their stockbrokers. They start checking this or checking that, which leads me to ask, why is it actually necessary to monitor stocks on the exchange?
Okay, thanks. For investment in stocks, part of what we should notice is long term. But because the prices also fluctuate, it is important to see how the prices are fluctuating. But if you invest in stocks with strong fundamentals and it's for long term, you don't need to be monitoring all the time. So when we talk about monitoring, it's not like a daily monitoring, hour monitoring that you are seeing price going down. It means that periodically, whether on a monthly basis or on a quarterly basis, you try to look at your position, what your stock is doing. If you are doing a daily, hourly, it means you are trading, not investing. Trading is short term and it's a bit speculative, and it's also for professionals rather than investing. Investing is for long term. And like Warren Buffett would say, if you cannot hold a stock for 10 years, don't bother holding it for 10 minutes. So you feel it's long term.
Okay. Now, the next thing I would ask is just how easy is it to go about monitoring these stocks? Is it an easy thing monitoring them on any exchange?
Okay, thanks. So I'll speak for looking at for Nigeria, data is scarce compared to developed climes. For other developed climes, you have the Yahoo Finance, Google Finance, where you can even create portfolio and simulate the stocks that you have, and you can be able to see whether it's appreciating, that means increasing or decreasing in value. But in Nigeria, they are limited in terms of data is limited. So we have the Nigerian exchange that will publish the price, and also stockbrokers. If you are registered with a stockbroker, price list at least is the minimum that they give to their investors or to their customers. So you receive the price list. And so, but it can be very cumbersome. And that is why you also need to understand what you need to look at when you are trying to invest in it. It's not just about the prices. Prices may go down, but if it's a strong company, it will eventually also go up and surpass its previous low or previous high.
Okay.
All right, interesting. When it comes to assessing stocks, of course, you do have to assess stocks, at least to know what exactly it is you're doing. Why are metrics important when it comes to assessments?
Okay, thanks. Metrics enable us to be able to measure performance, to be able to know whether they are doing well, whether they are on the right trajectory, and helps to make informed decisions. So when we talk about metrics, it's just some of the yardstick that you use to measure if they are actually doing well. So it's important to have those metrics, to understand those metrics. For instance, if it's profitability, if you are investing, we started with why do you invest? If you are investing for dividend and the company is not making profit, then you can't expect dividend. So you see in developed climes, companies make perpetual losses, but because people invest for the future, they invest for capital appreciation. That's expected increase in the share price of that company. They are not bothered about the dividend that they receive. So it's important to also to note that while you're investing, and those metrics help you to be able to measure and compare companies. So if I see, I don't want to go into those metrics now, but I know we discussed that. But looking at those metrics, it helps you to be able to compare company A and company B. Because once there's no metrics, even if A is making profit, you don't know whether that profit is more based on the industry that that company operates. So by the time you now compare them, it helps you to be able to know whether it's above, we say above the average sectors. It means if I have 5 companies and they are all doing 50 billion, 50 billion, 50 billion, I want to be able to see what are the other metrics. Are they efficient? What's their cost? So I look at what's their cost as a proportion of their profitability. And I want to see which company is more efficient. Like the banks, we know those banks are always, they used to be very efficient, but now they are going the other way around. But because of that, you are always sure that that would translate into profitability, and you can be able to compare them and know the winners and the laggers.
Okay, now just to confirm, because it looks like from all that we said that it looks as though investing in stocks is not a short-term game or even a medium-term game at this point. It sounds like a long-term plan.
Yes, it's good to have a long-term plan for stocks, but sometimes they deliver in the short term. So for instance, for those that understand the market, so, and this is not a recommendation when I'm naming stocks, because your investment objective may differ. Yeah, so if for Zenith was trading as low as 20 Naira in November, and currently is trading at above 25, this is less than 2 months. So for those that understand the market, seeing it at 20, I was buying, and I was also buying for my kids because I buy for long time for them on a monthly basis. That's this 20 will not, it will not continue to remain at this level at that time. So if you understand the market and it is the psychology, what we see in Nigerian markets typically, or most markets, is that there's that bandwagon effect. It's now that it's 25 that when people hear, they want to now come and jump in. and they've lost that period, which is just about 2 months ago. So if you have that long-term horizon, you are buying in tranches, you just set aside. If you are not a professional, you can set aside to be buying on a monthly basis when you feel their value. And when you see that these stocks, maybe in the last 1 or 2 years, it has not gone this low, and you check their results. So when you look at their result, which is one of the metrics, you look at their profitability, first quarter, they release results quarterly. For most companies, you see the first quarter, it's positive, they are growing. When we say it's positive, it means they are growing in terms of profitability. You look at second quarter, they are growing. You look at the third quarter. So you expect that in the fourth quarter, they would also grow if there are no major surprises. So that would drive interest in the stock. And you also look at, once they are profitable, they will also be able to pay dividend. So if I see that this company, people buy for dividend, and when you look at likes of there are banking stocks that give dividend of above 10-15% that are higher, that when you look at the dividend yield, they're higher than what you get in fixed income. So what I would say is that, yes, why we're saying it's for long term, or it's either for medium term, once you have that plan, you won't be forced to sell at a loss. Why, as professionals, why we always say don't buy stock for short term is because it's in cycle. If you need the money, it may be down at that particular time. So I would wrap up with this quickly. It's during COVID, and I will still use Zenith. Zenith Bank was as high as almost 22 naira. But by the time the COVID came, that's in 2020, by February, March, in April, it had gone to 9 naira 75 kobo. Those that don't have the mind took losses. And before you know it, before the end of that year, it came up to almost 30 naira.
Oh, wow.
Yeah, so you would see that if you are trying to trade, it may be after you sold at 10 naira that you still see the same stock at 30 naira.
Can you just imagine?
And once you crystallize the losses, you can't recover it. So it's good to plan a long term. Don't use your rent and put it in stock, trying to see you want to turn it around so you don't slip out. So those are short term. But once it's for investment, then I think you can be rest assured that if you are in a good name, it will always deliver.
All right, we're going to take a quick break, but when we get back, we'll still be talking about basic stock investments and metrics to live by in this year, 2023, as an investor. All right, keep it tuned.
It's all about your finances made easy.
Because financial education is
Man,
not working for
20 naira down to 9 naira, up to 30 naira. I would be in tears. I'd be crying hot tears at that point in time. Money has gone.
It's time to take advantage of the Airtel Home Broadband all-time mega offer. Get a MiFi with up to 125 gigabyte bonus data for just 5,000 naira.
For when a nice and gray hair.
For just 10,000 naira. Visit any Airtel shop.
What about you?
www.airtel.com.ng/HBB.
Unless there are stocks that my friends bought for me that I don't know about. I don't have any stocks of my own.
Do you have any sort of investments?
Here and there.
Mutual funds,
Yeah.
Oh,
Do 50 jumping jacks.
I've already done that. That's what let's be like.
Company's tax returns on time. To all employers of labor in Lagos, you have till 31st January 2023 to file your company's annual tax returns.
Sorry, Ayo, how do you pronounce your surname like properly?
Ebo.
Ebo, okay.
Ebo, like Oyinbo, Ebo, yeah.
Okay, all right. Thank you for that.
Click on File to upload the populated returns template and submit. All employees' taxpayer IDs shall be required to complete the filing process. Take notice that failure to file your company's annual tax returns on or before the 31st of January 2023 is a contravention of the extant provisions of the For more inquiries, call 07 or visit visit us from the Lagos State Internal Revenue Service, LIRS. It's your finances made easy.
Because
All right, and we're back in.
it's about not working for money,
Personal finance on Smooth 98.1.
All right, here we are back for more on a personal finance, still 5:45 here on the Smooth Drive. And we are speaking with Ayodeji Ebo, who is actually coming in and talking about basic stock picking metrics, what we need to watch out for when we're picking stocks, if we are indeed picking stocks. And if you leave this with anything in mind, it's, you know what, get invested in some stocks because they go down, but then they go up.
Oh yes, a roller coaster ride.
And the whole point is that you want to leave when it's up and enter when it's down. All right, so Ayodeji, here we go. We still got more questions for you.
Yes, we do. So let's jump right back into this. So when it comes to stocks, I'm going to give you some options here. When it comes to stocks, which of these options is the best approach?
Ayo, you like multiple choice questions, I've noticed.
Yes. I love multiple choice questions. Anything in theory, please help my condition. All right. Option A, monitor the stocks yourself. Option B, outsource monitoring to a finance professional. Or option C, option A and B.
Okay, option A and B. Okay, interesting. One thing about investment is it's always unique, and that is why the answer will not be general to all. You need to first understand yourself. So when you talk about the first one is monitor it yourself. First thing is, do you have the time? So if it's someone that will not have the time, even in 6 months, to even know what the share price is doing, to see whether results have been published, to monitor the performances of that company, the best thing to do, if you have means and if the volume, because there's a minimum when we also ask you to, if you want to monitor, or outsource it to professionals to help you monitor. There's a minimum volume because it also takes time that they will accept. So the best thing you will do if you have not attained that volume that you can outsource is just buy for the long term.
Okay.
Buy over time. And you can do it if it's on a weekly basis, on a monthly basis. Identify stocks that have strong fundamentals and keep buying. And you can target stocks that will at least give you dividend, which will give you a return even when you are not selling. So, but outsourcing needs can also be very positive if you are lucky to have it when you give it to a professional that understands the market. Not everyone also understands this market. So, because when you are also outsourcing to a professional, most times because it's stocks, nobody would underwrite whether it goes down. It is for them to guide you. So in portfolio management, we have what we call discretionary and non-discretionary. I'll break that down. Discretionary is that the portfolio manager has that discretion to select what to buy or sell. So what the portfolio manager gets is a management fee, and sometimes there's that incentive that is built in. If I cross a certain threshold return, I also get from that return. But for non-discretionary, so I will still tell you that I need to buy Zenith. This is what I think. This is why I need to buy Zenith. So you also need to choose. So that I think why some will also do that is they just don't want the portfolio manager to just get anything to their portfolio. So I would say both are good, but they have their pros, they have their cons, and it's also down to the individual of what is your threshold, what are you able to do. But if you feel you can't have the time to monitor, then just switch into buying in bits. And if it's developed markets, there's what we call exchange traded fund, which is a basket of stocks.
Okay.
So like sometimes I buy just the S&P 500 if you don't have the time. So I just buy when the market was going down. We have it at Vanguard 500. They mirror about 500 most capitalized stocks on the NASDAQ stock exchange. So you don't need to even monitor. So whatever happens to the overall market will impact on that portfolio if it's positive, and if everything is going up, it also impacts on that portfolio.
All right, now let's start with look at some of the metrics, starting with dividends. So, what are dividends? Why are they important?
Okay. Dividend, I will put it in a simple way, is like a reward to shareholders. So it's a distribution from profit. So before we would have dividend, there must be profit. Well, there are instances where companies have not made profit, but they still pay dividend. And why I'm emphasizing that is that they pay from their retained earnings, which is also profit they've made in the past, which they have kept. So when you see companies, they made a loss, but you are surprised they still pay dividend because they made profit in the past. Or some even pay more than what they made in that particular year. So it's a distribution. And that is why it's important when you see companies that are not performing well. At the end of the day, it is from profit they will pay you. So you want to quickly exit and we call it restructure or rebalance your portfolio. So if I know that there's something happening, maybe the insurance sector has been challenged for a while now, and I feel that dividends will not be forthcoming from that sector. So why I may want to just exit that sector and move to a sector that I feel will perform better. So that it's really very important that you track and you understand that dividend would be paid based on the profits.
All right. So
let's take this message that came in
WhatsApp,
from Gilbert Musa from First Stack Up on WhatsApp, who has some questions. He said, so what was the major cause of the global market crash in 2007? What is the level of individual participation on the Nigerian Group Exchange today compared to the level in 1997 and 2004? Is there an increase or is there a decrease?
Okay, thanks. Very intelligent questions. So the first one, we all know what subprime lending. So there were structuring.
Fannie Mae and Freddie Mac.
Yes, so structuring lendings that are not of good quality. So I'm trying to not to be very technical. So when you give credit, you know this person doesn't have the ability to pay, but you still give the person credit, and you had people repackaging that credit, we call it securitization, and reselling to other people. So at the end of the day, it was like kicking the can down the road and like a time bomb. And when that ripple effect, when we saw that when one defaulted, it affected the rest, which you know that would also impact on the market. So there are several factors that impact on the market. So if the economy is not doing well, because a lot of people that lost their money would want to first sell down the shares that you even have, you want to sell down. Also, those companies too, when the demand will reduce, even if they are also borrowing. So that's impacted, and as a result, the market dipped significantly. But for those that understood the market, yes, if you have lost money, some also took advantage, and we saw that jump in after 2 or 3 years after. It is what happened last year because of the increase in US Fed rates. Market was really down almost throughout last year, but we saw the significant jump early that we've seen this year because of the expectation that inflation would be tamed. Yeah. Also, to the second question, based on the statistics, the retail investors are the one controlling the market. We're all aware that foreign portfolio investors have pulled out since 2020, and their participation, when you look at the ratio, it's around between 75% retail and domestic investors compared to 25% foreign investors. And when you look at those domestic investors, we can say it's about 50-50, both domestic and institutional investors. So what it also helps to do is create stability, because when foreign investors are pulling out, sometimes they don't look at the price, and you see markets on a free fall. That helped the market even last year. Yes, market dipped, but at the end of the day, there was a level where local investors will not be comfortable to sell, and you will always see a rebound.
Interesting. All right, Ayodeji, could you just really quickly tell us about dividend yields?
Okay, thanks. Dividend yield, I would say, it's like a dividend return. The dividend the return that you get as a result of paying you dividend. And putting it into better perspective is that if you buy a share, a stock company here at 10 naira, and they are paying a dividend of 1 naira, that 1 naira is like your income distribution that comes to you. 1 naira divided by the 10 naira gives you 10%. So it's your dividend that is paid on one share, divided by the share price of that company, gives you the dividend yield. So the yield may look technical, but you can say dividend return. It's like a return that you get based on dividend.
Okay, so what is capital appreciation? And how do dividend yields work hand in hand with capital appreciation when we're assessing stock market returns?
Okay, thanks. There are two major types of returns that you get when you invest in stocks: dividend yield and capital appreciation. So I've explained dividend yield. Capital appreciation is the increase in the share price. So you buy at 10 and it moves to 20, you would see that that's 100% return. So when you're looking at the overall return on your portfolio, you don't just look at the return based on dividend, you look at the return based on your dividend and the capital appreciation. So using the example that I used in the past, your dividend yield is 10% and the return on your portfolio is 100. It means the overall performance of that portfolio is 110. But if we are trying to look at in terms of the relationship, so when you see share price, because share price is the determining factor. When the share price of a company is going up, and the dividend, if the dividend does not increase at that proportion, the yield, which is the return that you get, will reduce. Because if the share price used to be 10 naira and it's now 20, and they still pay the same 1 naira, it means that the yield, your return, dividend return, has reduced to 5 naira. So it's important that if you are buying for dividend, sometimes if prices have moved significantly and the fundamentals in terms of performance of that company has not moved at that same level, then you may want to reconsider your decision.
All right, and I think that's all we've got time for. It's been an interesting conversation. Hopefully, we're now thinking about stocks and what goes into picking stocks. There were some other metrics we couldn't get into, such as sales and leadership. But I think we at least have a pretty solid base for liftoff. All right. So to end the show, I'd like to say a big thank you to our guest, Ayodeji Ebo, who is the MD and CBO of Optimus by AfriInvest. Thank you so much for joining us today and explaining everything so easy peasy, actually.
So simply.
Yes, simply, that's the word. Deceptively simple. Yes. All right, Ayodeji, thank you so much. Have a wonderful evening.
Always my pleasure. Thanks for having me.
All right.
Bye. And that's that for personal finance for